So you guys have had me working overtime. I'm working all day, I'm working all night, helping you in the Discord, making the courses, doing the one-on-ones, preparing for the Wheelhouse Wednesday, researching topics for YouTube, trying to help you, educate you, and I can't even get outside, right out this door into my backyard for this. But it's okay, because when I'm in here, it's all about this. Now remember what I told you, no loose talk, no second thoughts, and definitely no maybes. And like I always say, green lights to the beach, baby. All right, so if it's your first time on the channel, welcome to the Wheelhouse. My name is Chris, and I would appreciate it if you would like, subscribe, and select all for me before we get started. We are going to talk about 21 of the most common and costly mistakes that investors make. So real quick before we get started, if you are not in the Discord, I put the Discord link below in the description, okay? You can come in there for free. Real cool. We got a crypto chat room and a stock chat room, and you can talk in there with everybody, that's in the Discord. And if you want to upgrade for my trade alerts, or for Full Jedi, where you get the trade alerts, the Wheelhouse Wednesday, that's a group training. Weekly, you get all the courses, which I'm constantly putting in courses. I just uploaded a new one tonight. And you get all the Jedi chat room, the elite area, you get the personal mentoring with me as well. And it's quite an experience. We're going into a tough market. I started talking about this in November, that we were topping out. I'm really good at that stuff, and noticing it early, before the people on TV, before a lot of people will notice. They're still figuring it out. That, I don't know, how sometimes people will show you that old chart of the market phases with euphoria and denial and stuff. People might just kind of still be in the denial stage. I just see it coming. I see it coming early. Do I think it's going to be cataclysmic and the worst thing we've ever seen? No, I don't think it's anything like that. But I do think that there's going to be a correction. I think the correction already started, back in probably the September area, and the way it works, it's like a bubbling effect. Okay, so the topping, I haven't explained this to you. So how do I explain this? Okay, so there's multiple divergences. Okay, so if you have more 52-week lows than 52-week highs, that's a divergence, and that's a decline. If you have more decliners than advancers, that is something you notice on market breadth, and vice versa. Then it shows up in the volume. So markets are always going to rotate. They're just always going to rotate. And traders are always going to expand the volume in the rotation, which is going to create these bubbling effects where you get amplified, and then there's rotations where it dips and it amplifies. And it's just a bubbling effect on tops, okay? Now, I haven't really gone through this with you guys. This is just a different way to explain it. But what happens is, eventually, okay, when a market is really healthy, the NASDAQ will also always be really healthy. The first thing that breaks is the small caps, and it happens many months prior. And then usually the higher PE and the NASDAQ, the tech will come down. And then that's currently happening. And what that is it's not necessarily a rotation into another sector. Okay, it's not necessarily a sector rotation. It's more of a flight to safety consolidation into safer plays, like the Dow, which is the strongest of the indexes, or leaders that they're not going anywhere. They're not going bankrupt. They've been around for 100 years, and they're staples of industry and captains of industry, if you will, like the Disneys and Microsofts and Apples, of course, and eventually, when it all kind of starts to come down, there'll be a consolidation, and the bigger companies will start kind of swallowing up the smaller companies. In fact, just yesterday, in the morning, I put out a video that I had made the day before about this consolidation, and I used Microsoft as an example. And lo and behold, I woke up in the morning and Microsoft consolidated and swallowed up Activision. That's exactly what I was talking about. That is exactly what I was talking about. So, and by the way, that's a cool story, the Activision Microsoft thing. And also SoFi got their charter, another big story. I was going to make a video on just Activision and SoFi, but I wanted to kind of, and it would have been good to do that, but I wanted to kind of just kind of continue to make some educational videos, kind of just continue to help people out. I feel like, everybody kind of has their niche of what they do. Some people are, they want to be comedians and entertainers, and, some people, want to be, more, factual and educational. And I think that's the route I want to be. I want to be more like helping people really learn. And I brought down like 50 of my financial books down into this room, and I got a whole bunch of them down here. So I'm going to start like going through different ones and, just going through topics. And, I think it's best to learn like factual. There's so much misinformation out there. Some of it you're not supposed to know. Some of it people just don't know, and they shoot from the hip, and a lot of it is opinion based. Like I was trying to explain to you in the last video. Like you can go to, I don't know if it was Barron's or Market Watch or whatever, and they showed you the interest rates, how like when interest rates came out, things went up. Okay, that right there, that's a total false. Okay, and that's what I was trying to talk to you guys about. Money managers and people like this, they have an agenda. Okay, so they're always going to pick a time period that is extremely rare and an anomaly across the history of the stock market. So that's what's called a secular bull run. There was only two of them. The first one was prior to the 1929, and the second one was 1981 to 2000. They were secular bull markets. After, always a secular bull market is a secular bear market, and that means that the indexes are declining or going sideways. Okay, and they always follow each other. Now they're longer, those secular bears, and there's secular bulls. And then the average of the bull runs are shorter, and the average of the bear runs are shorter. And they go in and out of the bigger secular, okay? And it might be a little confusing, but basically the whole stock market, when you don't just look at part of the picture, you look at the whole picture, so you can get a better scope of what's going on. So you want to know kind of the facts, and if you know the facts and you know the history, then you usually can find the solution. Like I was explaining in the 2008 financial crisis, a lot of people probably didn't know that when Clinton was president, he had coerced and enforced the banks to loosen up their safe lending policies that they had for years. It's called the CFRA Act of 1977, and they enforced it, and they were going to penalize the big banks like Lehman Brothers and Goldman and JP, and they were going to penalize them, not let them get M&As done, not let them get charters done. They were going to penalize them with fines if they didn't loosen up their safe lending policies. And it was the government actually that kind of made the banks, and this is fact, made the banks loosen up these lending policies and do adjustable rates and a lot of subprime lending. Were the banks guilty? Did they go way beyond what they were supposed to do? Yeah, they're guilty. Don't get me wrong, for sure. But that is why they got bailed out. That's one of the reasons why. And that is not the story you'll ever hear on the news. And so on this channel, I want to tell you the facts. I want to tell you the real stuff, the nitty gritty that's behind the scenes, because there's a lot of BS out there, and a lot of people just might not know the real story behind a lot of stuff. You're never really going to get the real story on the news, just like you're never going to get the real story from a politician. You're never going to get, it from a fictional book. You have to read the facts, and I read the facts, and I'm going to show you studies, and I'm going to show you, the real situation. That's why I was able to say this in September. And I think there's a guy, I like him on YouTube, he was the next guy to call it out. And that was in December. He was behind me a couple months, but he was still way ahead of everybody else. And I started watching his channel, and he's a big YouTuber, but he's a no BS guy. He knows what time it is. He knows what's going on. And he called it. He's like, don't buy the dip. We're just getting started. You don't want to average down. He knows. There's no book out there that says buy the dip or average down. In fact, I brought like 50 of them down here, and at one point I'm going to go to every single book and tell you what every major legend of Wall Street says in every book about that topic, so that you who want good information, who are eager to learn and to have financial freedom, are learning the right way. Remember what I said about successful people. They're not lucky and they're not right. They work harder and they try more, okay? That's going to get it done. So if you're not in my Discord, jump on in. I'd love to meet you. You can DM me. We could talk. You can talk with everybody else. And if you want to upgrade, go to the start here and then subscriptions. It's $99 a month, okay? That's not a lot. For what you get a tremendous amount of knowledge and support and mentoring, and you're part of a community. And you know what? It's straight up cool. So jump on in the Discord, and I can't wait to meet you. And let's get started. So, some of the biggest mistakes out there, it starts with you and me, okay? We as people are our own worst enemies sometimes. Sometimes we build up our weaknesses until they become the strong points, when really we should be focusing on the strong points. And a lot of people don't make money in the stock market or make mediocre returns simply because they make too many mistakes. This is why you need a system. You need to have parameters. You need to have rules. You need to have conditions, okay? Those mistakes might not just be in the stock market. They can be in your career. They can be in your business. You have to be able to recognize those mistakes. You have to be able to see the faults in yourself. What is holding you back? Okay? Is it that you FOMO too much? Is it that you position size too much? Is that you go into margin in the wrong, when it's going down? Is your risk reward not set up right? What is it? I don't know. You get in the Discord, I'll figure it out with you, and we'll curb it right away. But, there's all kinds of different things that people do. And I'm going to go ahead and read from one of my favorite books, probably my favorite book. And it's pretty much my Bible, okay? In this book, it says, number 1, stubbornly holding on to your losses when they are very small and reasonable. So many investors just don't want to take any loss. But really what you want to do is you want to just identify that you made a mistake, it's going the wrong direction, and you want to cut your losses quick. No more than 7-8%. I cut them quicker. I tend to I'm seeing stuff at the maximum for me around like 3.68. It's under 4 for me. I don't like it. I don't like it. I just don't like it. I only like it when I make money. Yesterday was a really, 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 really bad red day. And I'm not, saying this to I know a lot of people probably have heard portfolios, but I made like 50 grand. And I had my internet was even out half of the day. I couldn't even trade half the day. But, I'm quick and I know what I'm looking for, and I know how to spot momentum, and I know how to intraday trade. And, I've been doing a lot on those little time frames and getting in right, getting my money in right off the pivot. And, so, it's already been a good year for me. I'm at like 35%, and the market is just horrible, but I'm also not staying in overnight. I'm not like trying to do all that quite yet. I think the market's going to come down quite a bit further. It'll come down for a while, and then it'll find its footing, and eventually the PE value investors will stabilize it, then the traders will amplify it, and round we go, round and round we go. It's just the way it goes. So yeah, you want to cut your losses quick. You want to clean out the weeds from your garden, and you want to just have your winning plants in there, okay? That was number one. Number two, buying on the way down, okay? Thus ensuring miserable results, okay? This is what's called buying the dip. This is number two. This is factual. This is in the book. There's a study. This is big time. Number two, buying on the way down or buying the dip, ensuring miserable results. A declining stock seems like a real bargain because it's cheaper than it was a few months earlier. But let's not forget that woman that bought Xerox in 1999 and then it abruptly dropped to $34. And it seemed really cheap. A year later, it traded for $6. Stop trying to catch a falling knife. Stop buying the dip. This is the number two reason that most new investors fail, because they buy the dip, and it's a super rookie mistake, and it's an amateur mistake. And in every single financial book, they will teach you this, and they will teach you this in college, and they'll teach you this when you get your series licenses. You don't do it that way. You wait to establish a floor. You buy off a pivot or a sound base. You don't just like, you never know. Things can go down for 6 months, and you're just buying the dip. That's ridiculous. No, you can't do that, okay? Number three kind of goes in with number two. Averaging down in price rather than averaging up when buying. I always average up. I scale into strength. I buy off a pivot. I buy off a breakout base. I scale in no more than 5%. From the pivot or the base. You put money into your winners. You don't average down into your losers. Okay. Look, that made number two and number three. This guy's serious. If you buy a stock for 40, then you buy more at 30, and your average cost is 35, you are following up your losers and throwing good money after bad. The amateur strategy used in any individual stock could produce serious losses and weigh down your portfolio with big losers. Number four, not learning to use charts and being afraid to buy stocks going into new high ground off of sound bases. Yeah, you want to buy off the highs. You want it to make new highs. That's what you want. You don't want, in order for something to go 300-400%, it has to go 1% at a time and make all-time new highs every week. You should be looking for all-time new highs out there. Those are the leaders, and they will have high PE because there's high demand, which will reflect in a higher price. I know it sounds backwards to a lot of stuff you probably have heard, but this is the right way, actually. Number five, never getting out of the starting gate properly because of poor selection criteria and not knowing exactly what to look for in such a successful company. Guys, you're looking for a company that has products, services, good management, institutional support, killer earnings. I'm not talking about just like a one-hit wonder. I'm talking about, 5 years of good earnings would be pretty darn nice. And the earnings should be growing. The earnings per share should be growing, not just quarter over quarter, but from the previous quarter a year ago, from the same quarter a year ago would be a better way to say that, and or the right way to say that. So then what you're looking for is no less than 20, but really you want stuff that's like 70% or higher on the earnings per share beats. That's called a surprise, and that creates acceleration in the stock price and value. Then you want high revenue beats, annual revenue beats. Very, very important, okay? So yeah, you can't get out of the starting gate unless you know what a leader is, and it's backed up by institutional support, and it has the core fundamentals of great earnings, and it has products and services and management, and it's in the right sector, and it's dominating that sector. Now you're out the gate running hot, okay? Number six, not having specific general market rules to tell you when a correction in the market is beginning or when a market decline is most likely over and a new uptrend is confirmed. Guys, every day I get on YouTube, I talk about trading with the trend, okay? I talk about directional trading. I talk about confirmations of follow-through days and distribution days, and I talk about rules and conditions, and that is what number 6 is about. If you have a plan, a strategy, and a system like I do, then you you're in a safer, you have rules, so that you can't lose as much. You have rules before you buy and how you buy, how you enter, how you exit. The strategy in the system has a higher win rate. And that's what the author is talking about here. That's why you need to hook up with me and get in that Discord if you're serious about making money. Now, number 7, not following your buy and sell rules, causing you to make an increased number of mistakes. What do I say? People are their own worst enemies. They either don't have a system or they bounce from system to system. That's why I tell people, look, if you're going to do this, choose your time frame. Enter when this happens, exit when this happens. Even on this time frame, I can show you 4 different strategies. One's going to be the tightest, one's going to be tighter, one's going to be looser, but it's going to be more trend, and I can show you all within that time frame. And you can base that off the market environment. So yeah, you need to have your buy and sell rules always, okay? I just made a video on how to sell a stock, okay? Remember the biggest leaders, they go up 20 to 25% and then they pull back pretty deep and create a new base before they break out again. And I was explaining that you buy, and once it starts running, you scale in more. And when it gets to 20%, you pull off half the position. If it falls into a base, you pull off the other half, you let it go through its base, you let it break out, and those leaders will make another 20, 25%. That's the G method, baby. That's how the pros do it. Okay? Remember, we're talking about how amateur investors make mistakes and what they do that cost them money instead of making money. So you want to do the opposite. What I'm reading, and then you want to do the stuff that I'm narrating after. Number 9, failing to understand the importance of buying high-quality companies with good institutional sponsorship and the importance of learning how to use charts significantly improve selection and timing. Just talked about good companies, services, products, institutional support, earnings, and you guys, technical analysis is critical, and I would agree with the author here. Number 10, buying more shares of low-priced stocks rather than fewer shares of higher-priced stocks. When you're buying all that stuff down there, then you're bargain basement hunting. Okay, you're not doing yourself a service. As an investor, you have hard-earned money and you have a choice. Your choice should be to buy the best company with the best revenue and earnings and products and all the things we just talked about. You should put your money into those companies, not these fly-by-night, maybe not, they'll go bankrupt, never heard of them, barely have a product, definitely don't have revenue. Stay away from that stuff. Anything under $20, you pretty much just stay away from it for right now. Except maybe SoFi. SoFi's kind of cool. Palantir's a good one too if you're going to hold it for a while. But I don't want anybody holding for a while right now. If you're going to buy, wait for this whole market to come down to wherever it's going to go. Let it establish the base and the pivot and get strength and show momentum with a directional change, and then the coast is clear, and you have the protection of the trend, right? So number 11, buying on tips, rumors, split announcements, and other news events, stories, advisory service recommendations, or opinions you hear from other people or from supposed market experts on TV. Okay, so first of all, let me tell you something. If you're hearing it on TV, you're hearing it too late. Okay, number 1. Number 2, it's best to do your own research and to have conviction. When you're have an account that's under like 200 grand, you really don't need more than at the max 10 stocks, and you can have a little bit less. It's better to have a better position size on really good companies. And if you had a smaller account, you can have 2, 3, 4 stocks. You don't have to be overly diversified, but you need to have a few baskets and watch those stocks very carefully and baby them and make sure that they're those flourishing good little plants in your garden and they're not weeds. If they are, you need to cut them out and put that money into your winners. Okay, but do your own research. Don't listen to all these other people. If you understand heavy machinery and you want Caterpillar, great. If you understand gene editing and you want CRISPR, great. If you understand, technology and you want to buy, NVIDIA, great. Don't be like coerced or made to feel that your money should be put in somewhere that you're not comfortable putting it. Okay. Number 12, selecting second-rate stocks because of dividend or low price-to-earnings ratios. Dividends and price-to-earnings ratios are anywhere near as important as earnings per share growth. In many cases, the more a company pays in dividends, the weaker it may be. It may have to pay high interest rates to replenish the funds it is paying out in the form of dividends. Okay? That money gets taken away from like research and development and internal growth and expansion and things like that that could also help the stock price. Okay, number 13. Wanting to make quick and easy buck. Wanting too much too fast without doing necessary preparation, learning the soundest methods or acquiring the essential skills and discipline can be a downfall and has been for many. So, plan everything out. Be strategic. Talk to me. Get in that Discord. Number 14, buying old names you're familiar with. Look, the leaders of one bull market most likely won't be the leaders of the next. Okay, there is a percentage that it can be, but it's less than 5%. So 95% chance that the leaders today or recently will not be the leaders next time. Okay. Number 15, not being able to recognize and follow good information and advice. Friends, relatives, brokers, and advisory services can all be sources of bad advice. Only a small minority are successful enough themselves to merit your consideration. Many brokerage firms have gone out of business because they couldn't manage their own money wisely, let alone yours. Don't go to brokers. They're all sharks and they're all liars. Don't even deal with it. Telling you, learn how to do this yourself. Let me help you. Number 16, cashing in small, easy to take profits while holding your losers. That one can get you bad. In other words, doing exactly the opposite of what you should be doing, cutting your losses short and giving your profits more time. Don't sell your winners and keep your losers. A lot of people do that, and a lot of people are in trouble for that. I'm sure right now. Number 17, worrying way too much about taxes and commissions. Guys, don't even think about it. Like, if you're paying taxes, then you're making money, okay? Right now, you should be focused on making money in the market, not like thinking about, if I make some money, do I got to pay taxes? Dude, you're going to have to pay taxes. It's just the way it goes. Like, a successful trader should be happy to pay some taxes. That means they're making money. I know it sucks, but you got to, look, you're playing the game. Like, the game is to win. The game is to get the other man's king. Call it game over. You know what I mean? Get the money printer out. And you have partners. It's like the mob. You want protection on your restaurant, you got to pay. You got to pay Vinny. You know what I mean? Vinny's going to come around. He's going to take a little envelope from you, but he's going to make sure that those guys down the road don't steal your Hennessy and all your stuff in the restaurant, okay? Not mess with your girls and stuff. You got a partner. You got to get him an envelope. It's fine. We'll worry about it. Okay. Number 18. Speculating too heavily in options or futures because you see them as a way to get rich quick. A lot of people do options. It's another form of leverage. I'm not here to say bad or good about options. I think if you're going to do options, options can be very, very good. But with options, what I would suggest is understand what you're doing and understand everything about options and the contract. Okay, and don't have everything in options. Have a smaller percentage of your portfolio in options, if that's what you choose to do, because the risk is higher and the reward can be as well. But just keep that in mind. You don't want to just put it all in options. That's a lot of people get in a lot of trouble that way. All right, number 19, rarely transacting at the market, preferring instead to put price limits on buy and sell orders. By doing so, investors are quibbling over eighths and quarters of a point of decimal equivalents, rather than focusing on the stock's larger and more important movement, With limit orders, you run the risk of missing the market completely and not getting out of stocks that should be sold to avoid substantial losses. He's right. He's actually right. I use limits. I use stops. I use stop limits. I use market orders. I use all of them. I mean, every tool in the tool chest has a purpose. You know what I'm saying? So you know, you want to have all the tools. You know, you want to open up the tool chest, and you know, whatever the situation is, you want to be ready. You know, that's what being a Jedi is all about. You can levitate, you can see the future, you can print money, you can basically do all these like crazy things. If you know, you can go up, you can go down, you can intraday, you can, you know, you can do all kinds of things. You just have so much in your tool belt. You know what I mean? That you can. Sometimes you don't want to know too much that it distracts you. Like sometimes I feel like I have too much information and it slows me down from making a decision. But then sometimes I'm like, wait a minute, let's just simplify. Remember your math teacher back in like, I don't know, 5th grade or 7th grade or something, they would say, reduce the variables and simplify. Well, yeah, sometimes you got to reduce the variables and simplify. And your math teacher was right. And, you know, sometimes you just got to, is it in the right sector? Does it have volume? Does it have momentum? Go. You know what I mean? Like sometimes you don't need all the indicators, and you just need the price action and the volume. And hey, this is a sector that's running. This is, hey, it's semiconductors right now. Pick any one of them, you know. It's energy. Pick any, you know, just follow the money, you know, simplify, reduce the variables. Okay. Number 20. I think this is a big one. Not being able to make up your mind when a decision needs to be made. Many investors don't know whether they should buy, sell, or hold, and the uncertainty shows they have no guidelines. Most people don't follow a proven plan, a set of strict principles or buy and sell rules to correctly guide them. Guys, this is what I'm here for. I have all the rules. I know what all the best traders and investors and systems, I know what they all are. I've done them all. I know what works the best. And I can help you with that. So if you are losing money, and if your last 5 trades are all down and you're getting whipsawed and stopped out, or you're not even using a stop, or whatever the case is, let me help you. That's why I'm on YouTube, is to help you guys, okay? So let's look at this last one. Number 21. Not looking at stocks objectively. Many people pick favorites and cross their fingers. Yeah, you don't want to do all that hope, you know. Look at Wish. Look at Naked. Look at all those ones, you know. It's dangerous, guys. It's dangerous. You know, you want to have the earnings and institutional support, you know. Instead of relying on hope and their own opinions, successful investors pay attention to the market, which is usually right. The market has a consensus, guys. The market has a consensus, and the consensus is always right. You can't argue with the market. You can't argue with the trend. You cannot argue with the consensus, okay? Let's cut it there. I appreciate you. My name is Chris. This is Wheelhouse Trading, and welcome to the Wheelhouse.